Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Ernest Sweat. You ready? Let's dive in.
On today's episode, we're blessed to have Brian O'Neill. He's the former Chief Investment Officer at Robert Wood Johnson Foundation. He brings over 4 decades of investing experience in private equity and allocator strategy development. Today, he's going to share with us from his vast experience on what it means for venture capital environment today for allocators. Also, how allocators should approach venture in the light of the current cycle dynamics and put it in historical context. And lastly, he's going to give advice for fund managers and allocators navigating co-investment liquidity and structural shifts in the market. With that, we welcome Brian to the podcast.
Thank you, Ernest. Good morning. And yeah, I have worked in the investment business since 1980. It's kind of a long time. Only 2 places though, because I hate changing jobs.
That is fascinating and I just can't wait to dig into the topics today because you've forgotten more than I've ever learned in this industry.
Well, I will say I did have a meeting with Mr. Kleiner and Mr. Perkins in 1981, and they were pitching their idea for venture capital to the Equitable, and we turned them down, and it was one of the issues which, actually it wasn't a terrible thing that we turned them down because we were a large financial institution. We would have invested $5 million in their fund, and it would never have really moved the needle. Uh-huh. And right from the beginning, that's one of the biggest differences between venture and leveraged buyouts. Equitable was a big player in leveraged buyouts in the 1980s because we had a lot of money to put to work. We wanted to put it to work in equity, but even more so, we wanted to lend money to LBOs. That was the thing that we were really seeking to do. And so had some exposure, quite a bit of exposure to the leveraged buyout area and less so to venture. And then in 1992, the insurance regulations were changed, and it really cut back on our ability to invest in, quote, risky things. And I remember we did a big study of all the things that we did that were now going to be subject to this onerous haircut. And the best asset class turned out to have been LBO equity. That in the 80s and into the early 90s, it did very well. So we said, okay, our small amount that we can have, we'll have in LBO equity. And the leveraged buyout business has always been in a state of people saying, yeah, it's done well up till now, but can it continue to do well in the future? And I would say 40 years later, people are still saying that. So that's kind of an interesting perspective. In 2003, I moved to the Robert Wood Johnson Foundation, which had at that time about $8 billion in assets. So it was actually quite a bit smaller than the Equitable. And we did invest in venture capital, and we were of a size where venture capital could make a difference. But even so, the issue with venture has always been if too much money goes into venture capital, returns suffer. In fact, I would put it this way. If too much money goes into leveraged buyouts, returns shrink a little bit. Too much money goes into venture, returns collapse.
Yeah.
And we saw that in the late 90s. And I think we're in the middle of seeing this happen again from the excesses of the late 2010s and with the growth of growth equity into the hundreds of billions of dollars and funds actually bragging that they didn't read company write-ups, they just invested.
So many fund managers, aspire to be institutional, aspire to have a mix of LPs that come from, family office to fund of funds to large financial institutions and everything in between. But there are conflicting, they're just different incentives and things that people are looking for. So I want you to kind of share, working at, the Equitable to then the foundation, Robert Wood Johnson Foundation. There are different things people are looking for, and you guys are considering all different asset classes. Take me back to how, given the landscape you've painted so well, how do allocators even approach, first starting privates versus publics, and then, double clicking on privates, how to go and approach that?
Right now, every endowment and foundation, and those are the group of investors I'm most familiar with, is virtually in the same boat, that their private allocations got a little bit to the top of their range or maybe even above the top of their range, partly due to performance in the late 2010s, partly due to this appeared to be an even more attractive investment opportunity. And now they've had 3 years with very little return of capital. And meanwhile, a steady stream of capital calls. So they're now looking at our private portfolio is bigger than we want. It hasn't done well compared to the public markets. And we're faced with what should this year's commitment budget look like and where should it go? And basically, the first thing that happens is commitment budgets shrink because you're not trying to make the private portfolio even bigger. And then within that budget, priority always goes to the re-ups for the funds that people like. And it doesn't take too much of a cut in your commitment budget and too many re-ups to discover that you've got little or no money left for any new funds. And I think a lot of folks are in that situation right now. And this was supposed to be the year that the leveraged buyout business really returned capital and kind of hit restart. And it looks like it isn't going to happen.
So much talk has been about for venture fund managers that this idea of a 10-year fund is false. So many companies are staying private longer. Are you guys seeing a similar thing for LBOs as well, or is it?
There's a big debate in the LBO world about what are called continuation funds.
Okay.
A continuation fund is at the 10th year of the fund. The investment period ended 4 or 5 years ago, and the sort of the selling period is supposed to have ended by the 10th year, and there's still companies left in the portfolio.
Yeah.
And some of the LPs are saying, hey, this is supposed to be the end of the fund. We would like our money back. Would you sell these companies? And the GPs have a number of reasons for not wanting to do that.
Yeah.
And usually, you can get a 1 or 2 year of extension, but what they've started doing, and a lot of LPs really don't like it, is called having a continuation fund, where they say, okay, our portfolio is marked at 80.
Yeah.
And we will offer anyone who wants to get out a price of 70. Pay us 70, and we'll find new investors who will come in at 70. And that creates this continuation fund where they can actually hit reset on their fees and their carry and a whole bunch of reasons why it's good for them. And the word for this for LPs is it's coercive. Because almost by definition, you are not getting a very attractive price, because it has to be a price where the new investors want to come in and invest. And there's no way to balance off those two sides of the coin.
Yeah.
And so the only choice you have is to stay in, so you don't have to take that lower price. But a lot of LPs feel like we want the money back.
You mentioned just kind of the state of venture and how it's in some trouble right now in the market. How would you compare it to previous downturns? And we're not even technically in a downturn yet, but I feel like it's fastly approaching. How would it compare to that? SNL.
The late '90s was the crazy moment, and in fairness, even with the worst excesses of some of these big growth funds, we never approached the late '90s, where companies would deliberately lose money because that made their value go up.
Wow.
And there was this great commercial in the Super Bowl by one of these .coms, and they had a commercial and they just sat around and they said, "We just spent $1 million."
I have to find this commercial.
So we didn't have those excesses, but the private for longer and the free money and the very excessive, and also all the money coming in for sort of late stage venture, because that's the moment in the cycle when companies are supposed to think about going public, and instead they got large checks that would allow them to stay private, and also got a message, grow, grow, grow. And then when rates did start to go up, they got the exact opposite message. We actually want you to start making money, It's time to reduce headcount and get this company into the black. I honestly feel that there's a generation of those companies that they have missed their moment.
Yes.
And, I think if you're an allocator, if you're an LP and you have an existing venture portfolio, you're looking at it, it hasn't generated much cash for 3 years or so. The valuations are problematic. I mean, not that they're necessarily wrong, but how do you value a company that has really not kind of broken through? And they're looking at that and they're saying, what am I going to do with this?
Yeah.
Because this is not like just waiting for one more good year to start returning capital. And meanwhile, other venture funds are raising more money. And I think this is going to be one of the biggest issues that existing venture investors are going to have to deal with is, what do we do with our existing portfolio? Right now, nobody wants to buy it.
Yeah. Yeah.
But I think there could be an opportunity. You might say the bid ask is very far apart right now. But if you own something and you expect to get very little return out of it for the next 5 or 6 years, what's that going to do to the return of your whole portfolio?
I've been thinking about this too, on like as more and more capital has come into the private markets, and it seems like a lot of institutions that historically would have just waited for the IPO have now kind of like leapfrogged that to get in earlier and earlier to get some of that delta. It seems like there needs to be a reclassification of early stage venture versus growth equity versus whatever kind of that period before there's an exit opportunity. Do you think, foundations and endowments are thinking about it like that, or is so much coming at them, so much change that maybe that's not the right approach?
I think the growth equity stage is the one with big question marks around it. That most endowment and foundation funds tended to be a little earlier stage.
Yeah.
And while there's too much money everywhere, there's not as much too much money in these early stages, and new companies are coming along. But I do think it was that growth equity stage where maybe a company actually needed some money to build things, or just really wanted to get a high valuation and raise money. And that has to shrink. That throwing money at those companies really is bad for the earlier investors. Even though they put a high value on the company in that moment, you can't sell. And the ultimate fate of that company may be that it's going to be lower in value, the next time around, or maybe even as a company is not going to make it. So there's not a lot of benefit there. And the people who are coming in at these high valuations, the ones who did that in 2018 and 2019, they're looking at real losses now.
Yeah. I think we were on the verge of some real learnings and contractions, thanks to kind of, the ZERP, and, companies starting to stall a little bit, but then comes kind of like the white knight of AI. And we start to see some real gains, like consumer anyway sees generative AI is really something. And so it's really kind of conflated the natural contraction we were about to have to now, nope, we still have something and some hope and hype here. And I'm sure that's really made it even more difficult for, larger LPs and endowments and foundations from making how do you re-up, and then how do you find alpha in this market?
Those two questions are Ernest. I mean, first of all, and venture capital, if you look at the median venture capital funds returns, is not that attractive of an asset class. And I'll contrast it with leveraged buyouts, where the median LBO fund is decent.
Yes.
And, and it's not that hard to find people who are a little bit better than average. and then that generates some pretty good returns. In venture, if you got the median fund, it would be not very attractive at all. And so we are all trying to find the top quartile funds. And, there's a lot of this decision analysis that people are overconfident. I mean, I think picking venture funds is the perfect example of overconfidence in action. And, I think you really should be thinking long and hard about this. At the same time, people have learned that they always have to invest in venture. It's nearly a near religious belief that venture is the highest returning asset class. Keep investing and you will get paid. And how long? I think it could take a long time for that learning to go away.
Yeah. And it's like a caveat. It's like it is the highest earning asset class if you pick in the top decile or top quartile. Like,
Right.
But if not,
it's not even that great. But it's sort of like those studies with rats where they feed them and then they stop feeding them, but they keep pushing the lever, And I think we're still pushing the venture level, saying we're going to get returns. So, I honestly think that money needs to flow out of venture. That a number of things need to happen, but one of them is that.
yeah.
And I feel as though, the advice that I give people is you don't need to invest in venture. If you think investing in venture is a good idea, fine, but you don't need to. And you mentioned the time aspect of it. Because I honestly, towards the end of my time at Robert Wood Johnson, we're thinking about, we need to have some kind of time component to our commitment budget. Because committing to an LBO fund, which is probably going to be done or nearly done after 10 years, should cost a different amount than committing to a venture fund,
Yes.
which in year 10 might still be growing its companies.
Yes.
And nobody does that, but I think they should.
Now we're going to take a quick break to speak with our sponsor.
Hi, I'm Jeremy Rich, Senior Vice President on the Catalyst 2045 team at SVB, a division of First Citizens Bank. For over 4 decades, SVB has been the financial partner of choice for the innovation economy. We understand the unique needs of founders, fund managers, and investors building in fast-moving, high-growth sectors because we've been there every step of the way. Through the Catalyst 2045 team, we work closely with venture firms and institutional investors to help them grow their platforms, raise capital more efficiently, and unlock new opportunities across the venture landscape. When you work with SVB, you're not just getting a bank. You're gaining a partner with deep sector knowledge, extensive networks, and tools to help you scale. We're proud to support Swimming with Allocators and the people shaping the future of venture.
And now back to our LP interview.
You've seen enough cycles to. I've been surprised and not so much surprised on the amount of fragmentation that's starting to happen in venture. Not just the number of firms at the earlier stage, but the number of spin-outs in a pretty stagnant industry today, and people within the kind of the 10 years of experience in the industry, 35 to 45, just saying, hey, we're going to start a new firm. There's, as much as you say, there's a kind of like gospel belief that you have to invest in venture. I think another trend is happening, or it's kind of bifurcated. It's either you invest in the blue blood names, or emerging managers is the only place you can get alpha. How should an allocator today of like, I'm sure there's probably like a balance between those two kind of schools of thought, or option 3, you said you don't have to do it at all.
Yeah.
How do you think they should address those kind of competing thoughts?
Well, I do think if you are in one of the really blue chip names, that their next fund may or may not be good, but it's probably a reasonable thing to stay with that fund. And then, I think for emerging managers, the thing that I always liked was to invest with someone that I had seen working elsewhere. In other words, not just someone who spun out of a firm that you never heard of, or putting it differently, for those folks who I don't know, what I want to see is that the first people who invest with them are the people that do know them. And so I think if you're thinking about starting a fund, or if you started the fund, it is crucial that people with whom you have invested in the past are supporting you, because it is a very powerful statement to people who you are meeting for the first time, that the people who were with me before have stayed. And
Yes.
so I think that the other thing is to recognize starting a fund today, particularly a venture fund today, is going to take you many years to have the chance to know whether you succeeded or not.
Yes.
And, because there's just not a lot of money available for new managers. And you're going to have to start with a fairly small fund and try to have success with that fund. And if you do, then the next one can be bigger. And, you're going to build a track record, but we know venture track records are long things. They're not short things. And so I think that's the perspective to keep in mind. And then if it still makes sense, great.
Yeah.
But that's the road that you're headed down. But again, the most important thing to me is that people who've invested with you in the past want to invest with you today. Because first of all, that will get you in business, size your business so that is enough, and then have some success.
Yeah. Another trend that I've seen a lot across private equity is allocators' interest in co-investments. Do you have any thoughts on this trend?
Well, co-investments tend to vary by the size of the fund. Like the state and local pension funds, they are counting on co-investments because they have $1 zillion to invest. And so when they sit down and they invest with the biggest LBO funds and they say, here's our deal, so much in your fund, so much expected in co-investments at a lower fee, and maybe also a separate specialty fund for just us in something that you do that isn't the fund in itself. So they have like multiple relationships with these big firms. And that also gives the firms the chance to go out and shop for virtually any transaction. Because if they need more money, they not only can get it, they have people pushing it at them saying, hey, we want co-investments.
Yeah.
And so that's at the very high end. Now, Robert Wood Johnson was a much smaller organization than those funds. And what we decided to do is if there was a co-investment where we had some industry knowledge of our own, we would invest in that. For example, Apollo sponsored Athene, a life insurance company. So I thought I knew a thing or two about that. And so we looked at it and we decided to invest in Athene as a co-investment. And that actually worked out pretty well. And I think the idea there is you're still trusting the manager to do the heavy lifting, but you want to see if you can add a little something that says, yes, this could be a better than average investment.
I'm not sure if you had any direct experience with doing co-investments in venture investments, but if you do, I'd love to hear that. Or if you don't, then like where do you think the issues are or challenges are for an allocator doing that?
I think most venture funds really are not looking to have co-investors because most venture investments are small. I mean, and also if the company wants to raise, say, 100 million, which might be too big for a fund, the first thing they're likely to do is to find another investor. So I think it's kind of a rare occasion when everything lines up and a venture fund would say, hey, we have a co-investment. But I think people, on the one hand, they like co-investments, lower fee, the fund is already in. On the other hand, in buyouts, every deal is supposed to work, and it's rare when they don't. In venture, it's kind of the opposite of that. And so putting a lot of money into one venture deal might not be the wisest perspective if it's really still in that early stage where there's a chance it goes to zero.
That mentality just there, which I know, but like you saying it really just stood out to me of like, when you're investing in an LBO fund, you expect even the fund manager themselves, they expect every investment to work out.
Right.
Whereas venture is like, hey, we have dreams of this working out, but we only need one or two to work out really well.
And we know that several are going to be zeros, and that's not even going to embarrass us.
Yeah, exactly. So are there any, you're still advising some organizations and staying abreast of everything. What are there any lessons from your time at Equitable or Robert Wood Johnson Foundation that you still like help guide you in these kind of unprecedented times?
Well, I think it's really important to go back to the basics and understand why is our investment portfolio positioned the way that it is. Like most foundations are very close to a 70% equity, 30% fixed income or non-equity exposure, because that's the only way that you expect to be able to earn inflation plus 5% without, massive volatility. That's kind of the sweet spot. But that's an important consideration because when the stock market is down, if you're going, well, why did we even own it in the first place? That's a very difficult decision. If you know that, yes, the market's going to go up and it's going to go down, we're prepared to work through all of that, then it's a much easier position to be in. And so and then the other big principle is diversification and understanding what is your theory of diversification and how confident are you that your diversification is going to in fact work when bad things happen. And that's in a way, the CIO's job is not to make the stock market go up, okay? You can't do that. But it is to make sure that the portfolio is diversified.
Yes.
So that whatever happens, the performance is reasonably within expectations for that environment. And so that's the biggest job.
We have a lot of individuals who are younger in their allocator career who listen, or that, for their organization, maybe asset class was only, publics and now they're going into privates, or only private equity now going to venture. Do you have any kind of like tips on how to get an edge up that learning curve?
Well, that's you just use the word learn. One of the great things about the investment business is that learning is prized. Learning is part of how you do your business. And you're almost always going to be said yes to if you say, I'd like to learn about this, or I'd like to learn about that. And so I'd say learn as much as you can and see if you can get over walls and through silos and, learn horizontally as much as vertically. And because these different asset classes, yes, they are very different and have different dynamics in some ways, but then in other ways, they're not as far apart as it might seem. And I think really understanding what are the true differences and what are the similarities is really very important.
I have to ask you, as someone who's held kind of the role of CIO, for people who are just stepping into that role, and maybe they were deep in just publics or just deep in a certain asset class, how does like that first year or so, like, how do you get your handle of what your role actually is to best position your entire team in the portfolio?
Well, Ernest, I can say this. I have had several conversations with someone who got a CIO job and called me up and said, I can't believe, and it's never about investing. It's always about other things. And it's usually about managing the investment committee. Particularly the endowment and foundation world, you have an organization, maybe it's a foundation. Like my first boss was a doctor who works with the elderly. I can't think of the name for that. She didn't know a lot about the financial markets, but she was the head of the foundation. And then I had a very experienced chair of the investment committee, but he's an unpaid volunteer. And so how do you keep those two poles that are so different, together and on the same page? And so a lot of it is the care and feeding of the investment committee. And I don't mean that at all in a derogatory way. They have to really understand what you're trying to do and be supportive and give you feedback. And then also managing an investment team inside an organization that does very different things, that can be very complicated.
Yeah.
And a lot of the bigger universities have separated their investment teams out completely to just try to get away from the governance of universities. But in most foundations, you're part of the foundation. And I mean, I will admit that we gave the HR group headaches because we were maybe 5% of the head count. We were probably 20% of the stuff they had to do.
Yeah.
And they didn't actually like that. So I think the big surprise in CIO jobs early on is how much non-investment work there is. And people just have to learn how to do that and learn how to delegate more if they haven't really had to do that very much. And then I think once you've kind of gotten through the first phase of that, it can be really fun because now you can really start building the portfolio in ways that make sense to you and make sense to the organization. And you're able to function at a level that is more powerful than anything you've done before. But in the beginning, you have to learn about all this other stuff.
It sounds very similar to when people spin out and they say, I just want to get back to the investing. And I was like, well, that's not the path, because you're going to have to do investing and manage team and manage LPs and manage brand and all these and
Final lease. And
get
service providers.
Service providers and get all those things. So no, that makes a ton of sense. To emerging managers, whether they've been experienced and you've seen them work at a previous fund investment or not, what advice do you have for them in developing that relationship and interacting with endowments and foundations?
I think it is to be patient and to see every meeting as a step forward in a long-term dialogue, because the reality is partly just the factors right now, but partly just the way things are. You're probably not going to get a lot of takers very early in your career. There are some entities that are set up to do that. And again, you have your sort of family and friend and your circle of people who know you and trust you. And that is where most of your fundraising is going to come from in the beginning. But people do have memories. And if you go in and you meet with an organization and you tell them, these are the things that we're working on and this is what we're doing. Oh, and we did make this investment and it's looking really good. You go back there in a year or two and you've shown progress on all those things, that will make an impression and that will make a difference. And so again, if you're going to start whether it's a venture or an LBO fund, you have a long road in front of you. And cultivating future investors is a part of that. It's not cultivating next fund or this fund. It is cultivating future investors.
Having that long-term view. A quote I got this weekend from someone was, success comes from doing consistently what others do occasionally. And I think that's exactly what you're speaking to.
Yeah, that and the overnight sensation who spent 20 years to become an overnight sensation. But yeah, that's really true. Showing that you have the right approach and the right work habits and the right understanding of how to grow your business. Those are things that people will pay attention to.
Well, I have one last question. This is why I wanted you on, to give a very real perspective of what allocators like endowments and foundations are going through when assessing venture capital. But I wanted to end on a little bit more inspiring note. But are there any trends within venture that excite you about the future? And this is a very long future.
Yeah, well, of course, AI is this, open door. And it's funny because at Robert Wood Johnson, we were investors in Renaissance, the Jim Simons organization, and they were sort of doing AI before it was called AI. And, first you use the computer to find ideas, and then you teach the computer how to find its own ideas. and then the computer tells you what it's doing. And, that cycle, people are now starting to use AI in their daily life.
Yes.
And it's really interesting because if it's just a question of consolidating information, like you can consult an AI and every single data point about something they know. And it's incredibly efficient, but it's just the very beginning. And, I think it is going to come into our lives in many different ways. But the internet took 20 years and it's still changing things.
Yes.
Social media. Nobody saw social media in the early 90s. that was like, Amazon was the big breakthrough.
Yeah. And it was just a bookstore. I think people forget.
Right,
Yeah.
exactly. Hey, this is a good way to, No, now the idea that you would shop from home for just about everything, and that people would bring things to your home every day, and that it's easy to return something.
Yes.
I mean, I remember when returning something was like so hard it wasn't worth the
It
trouble.
wasn't at all. Yeah, exactly.
And so, I think we're just seeing the very beginnings of this. And just as an exciting thing is this idea of personalized medicine. And I think that would be great. At the same time, I do honestly feel that our healthcare system is advancing technologically, but it's regressing in terms of its ability to deliver services.
Yes.
And that should be where the next big breakthrough comes, is how to help people stay healthier, as opposed to doing a better job of fixing them when they break.
Exactly.
But,
The whole preventative versus like reactionary care. Yeah.
Or just a way of making it easier to understand what's going on with your body. But that is probably going to happen too.
Yeah. It's exciting times.
For sure.
Brian, thanks so much for being on the podcast. This has just been, every time we speak, I get more and more nuggets and advice. So I really appreciate you coming on.
Well, Ernest, it's been a pleasure. It has been a pleasure getting to know you. I hope this is not our last interaction.
It won't be.
Absolutely. All right.
All right.
Take care.
See you later, Allocator.
After Portfolio Tile, investing with a smile.